Texas real estate.
Hi, this is Danny.
Hey, so let me tell you a story about this loan that we put together for a family. The married couple, they were living in Oregon. She's a teacher and he's self-employed. He may live anywhere and work. He's got a long history of self-employment. But she needed to, they were moving down to Southern California. And so she needed to get a position as a teacher because we needed her income to qualify. His income needed to be higher, a little bit higher than what it had been in order for them to qualify and make this happen. And we also needed 1 year of tax returns as opposed to 2 because we didn't want to possibly average the income. So we started talking to them a year and a half to 2 years before they were going to move down to Southern California. And the first thing, we had to get rid of some debt. We had to get the credit risk scores up. So we had them pay off the debt over the year and a half. We had them, which helped get their credit risk scores up so they could get a better interest rate. The plan was that they were going to buy his cousin's home down in Southern California. And the cousin was giving them a great price on the deal. So the cousin could gift them the down payment, and then the cousin could credit them for closing costs. But we had to make it work perfectly so that with the income from the tax returns that we had, with the automated approval that we had from Freddie Mac that only asked for 1 year of tax returns, the ratios had to work correctly, or the qualifying income had to work correctly. And so the last little aspect and calculation of this deal was that, there was enough equity where we could have gifted 20% down, but then the real estate tax payment was so high that their ratios weren't working. And so, all of these little intricacies of the loan, the final little intricacy that made it work was that we gifted the 10% down, and then we credited the closing costs. But as we increased that credit of closing costs, then we would have to increase the purchase price even more. So the final piece of that puzzle was, even though we got the credit risk score high enough so that we could do a conventional loan, it still wasn't really high, so the mortgage insurance was a little pricey. But due to the fact that they were gifting 10% down, we could finance that mortgage insurance premium, so we didn't have to ask for more credits from the seller. So we got a gift for the down payment, we got a closing cost credit, and we financed the MI, and our back-end ratio just snuck in there to make the deal work, and that's how we hit a home run on that loan.